Hey guys, this is Andre, hope you're all doing well. In this video, I'll talk about two very important concepts when you are trading securities in the markets and in particular in the Brazilian stock market. I'll talk about margin and collateral. Please read our disclaimer, and if you agree with all the terms and conditions, let's go. We'll start by talking about the risk perspective from our side, the trader, from the brokerage side, and from the Brazilian clearing house, and from the Brazilian clearing house, the CBLC side. Then I'll give a list of what assets can be used as collateral, and finally we'll talk about the margin call. The risk perspective from the trader side. Our positions are at risk when our strategies do not work as we expected. So when we are in long positions, if our strategy does not work, the stock price will go down. And as the stock price goes down, the market value of our investment goes down as well. Then we have to consider what we should do about this investment given our strategy. Maybe we have to hedge our position using another derivative, or we'll have to close the position altogether and sell our stock or whatever asset we bought and take a loss at this time so we can save our cash to finance different strategies at different times in the future. Now, when we are in short positions, risk has a whole different perspective. So when we trade on leverage, which is using money we don't actually have at the time, the more the price action goes against our position, the more collateral we will need to keep this position open. Keep in mind that all short positions are leverage trades because you are selling an asset you don't currently own. But by trading future indexes and options, you are also dealing with leverage instruments. So in this case, you also have the collateral requirement. Now the risk perspective from the brokerage point of view. If you want to open a short position or trade an leverage instrument, the brokerage will require some collateral. Some brokerages will take specific kinds of asset as collateral and some other will not, and they all have these different discount rates to the assets market price. It is your sole responsibility to know what are your brokerage rules. So most brokerages will take the following assets as collateral: stock shares, bonds, and cash. Brokerages will disclose their collateral requirements and asset discount percentages on their websites and on their FAQs or other documents. So please, before you trade any leverage instruments or before you open any short position, make sure to read all these documents and understand the risk management of your brokerage. And you will not be able to day trade, trade index futures, or open short positions without brokerage collateral. And finally, the risk perspective from the Brazilian clearing house, which will be referred to from now on by CBLC, its acronym. You can get a lot of information regarding the Brazilian clearing house from this link, which will be available in the video description. The most important points are that the amount of collateral to back up your leverage trades varies with market volatility, market liquidity, and how much this particular trade is going against you. The more risk you are exposed to, the more collateral the CBLC will ask from you. In the previous slide, we talked about brokerage collateral. Now, most assets allocated as brokerage collateral are also allocated as CBLC collateral simultaneously. So stock shares, for example, you have to allocate these shares to your brokerage collateral in order to open short positions or trade options. And the same and these exact same shares are also allocated as CBLC collateral once you open this short position or start trading options. Maybe the financial value itself is not the same, but the same asset is used simultaneously as brokerage collateral and CBLC collateral. And if the CBLC sees that if the collateral you have allocated is not enough to cover this maintenance margin on your current open positions, meaning that the CBLC perceives that your current open leverage positions can potentially cause you a financial loss that will not be completely backed up by the current collateral you have, you get what is called a margin call. We'll talk about this later. Now if you want to see the list of assets the CBLC accepts as collateral, all you have to do is follow this link. The list of collateral your brokerage accepts may or may not be the same as the CBLC list of collaterals, so check on their website or with customer support. And one very important fact is that collateral is usually never taken at market value due to liquidity risk. So if we go back to our stock shares example, you have 1000 shares of stock priced at 10 reais. This whole amount of stock has a 10,000 reais market value, but when you consider its collateral value, it will be somewhere around 8,000 to 6,000. And this discount is due to the liquidity risk. The discount rates are calculated by the CBLC daily. And the margin call, as we briefly mentioned before, a margin call occurs when a trader does not meet the current CBLC collateral requirements, which varies with market conditions and specific trade properties. Your brokerage will act as an intermediary between you and the CBLC. So if the CBLC issues you a margin call, the amount of collateral you should allocate to meet this margin call will usually be available in your brokerage statement. And in some cases, the broker will try to contact you to inform you about the margin call. If you are not able to allocate more collateral to meet the CBLC's margin call, the brokerage will close your leverage trades totally or partially until the CBLC collateral requirements are met. So if you have a leverage position and you are not able to meet the call requirements, your position will be closed regardless of your strategy, no matter if it's profitable or at a loss, in order to meet the CBLC margin requirements. However, in some brokerages, there is something called a bail letter, which is nothing more than the brokerage lending you money, of course you have to pay interest, to meet the CBLC margin requirements, to meet the margin call. Your leverage positions will not be forcefully closed. You have some time to decide whatever the best strategy from now on is, but you have to pay your brokerage some interest on this borrowed money. So guys, trading leverage instruments is no joke. Always read all the information you can find about your brokerage rules regarding risk management, and collateral and margin. Always make sure you know what kind of trade you're getting into, what is the worst case scenario, what kind of risk you're exposing yourself to, and make sure the eventual profit is worth taking this risk. Thank you for watching and see you next time. Bye bye.